Margin trading carries absolute risk. High leverage guarantees extreme volatility, and the baseline probability is a total loss of capital. The self-directed investor targets a specific mathematical state: total coverage of all annual expenses through capital yields. This graph maps the gap between passive income and financial freedom. Dollars are plotted against time. Passive income is the floor, while the financial freedom figure is the ceiling covering annual costs. The space between, the current deficit, is the void a trading system must close. The market is entirely neutral and indifferent. This makes the human operator the ultimate limiting factor in extracting capital. Every price tick is processed through your unique history, fears, and biases. Consequently, your screen doesn't show raw data. It shows a projection of your internalized beliefs. These beliefs form a cognitive filter. Market data enters, passes through the filter, and dictates your execution outputs. Without an optimized filter, incoming data bypasses systematic logic. It triggers emotional variance, which leads to erratic, undisciplined execution. Closing your financial deficit requires building an optimized execution filter to manage that data flow. Retail traders often mistake complexity for competence, searching for the perfect indicator or a flawless entry signal. Firmly, in reality, precise market entries do not determine your ability to reach long-term financial goals. Professional execution inverts the retail approach: simple entries paired with complex exits. Knowing exactly how much capital to risk on each trade determines the system's total impact. This is position sizing. An operational edge comes from mathematically defining your capital exposure before the market even moves. A single simple entry must instantly branch into 4 predetermined exit parameters. The first is the initial stop loss, which sets a hard mathematical cap on your absolute risk. The second is a risk to accept trades with high-quality return potential. The third is a time or level stop, designed to kill the exposure if the underlying thesis stagnates. Finally, the system must protect accrued profits and systematically allow winners to capture outlier moves. Engineering this matrix before risking capital removes the psychological burden of managing a live trade. Successful professional trading systems are built to lose more often than they win. This is risk asymmetry. It relies on a high frequency of small losses balanced by infrequent, massive wins. This requires the operator to treat individual losses as a fixed, emotionless cost of doing business. A strict risk-to-reward ratio on the exits ensures positive equity growth, even with a win rate below 50%. When your system ensures that winning trades eclipse the cost of losing trades, perfect market prediction becomes irrelevant. Long-term survival requires treating as a rigorously managed business operation. Every business needs a radar system. In trading, that means active market type identification. When the market type shifts, the feedback loop forces a dynamic adjustment to your position sizing and exit rules. This operation is sustained by strict trade journaling to validate the system's performance against current conditions. Static systems break in dynamic markets. Professionalism is defined by continuous, journal-driven self-correction. Maintaining the operator is just as important as maintaining the system. Higher emotional intelligence leads to better execution. The human asset requires maintenance, unplugging from the data, taking breaks, and sustaining a disciplined life outside of the market. Adhering to these habits returns us to the original objective of the self-directed investor. These operational systems slowly ratchet your passive income baseline upward, compressing the current deficit against your freedom figure. Trading is an engineered game where you set the rules. Closing the financial deficit is the mathematical result of choosing only the rules that provide a quantifiable edge.